Welcome to RAIN, the Real Estate Investor Growth Network with your hostess, Josey. Join like-minded real estate investors and accelerate your business towards greatness. You will hear step-by-step strategies for success, interviews with real estate rock stars, and we will dig deep into past projects where we bear it all, including the good, the bad, and some just plain ugly. So get excited. Here's the bestower of badassery herself, the real Josey. Listener discretion is advised.
Hi, and welcome back. I'm Josey, creator of RAIN, the Real Estate Investor Growth Network. Whoop, whoop. On today's episode, we have two guests who will be sharing their badassery. But before we begin, here's today's badassery bestowment, my little badass gift to you. Today's topic is why friends and family can be your best private money lenders if you do it the right way. Let's talk about the money that is sitting right under your nose. A lot of investors are out there begging hard money lenders for permission while their family and friends have cash parked in savings accounts, CDs, or the stock market earning cute little returns that don't even keep up with inflation. And here's the part that might ruffle some feathers. If you're doing solid deals and you don't offer the people you love a safe, simple way to grow their money with you, that can actually be a disservice. Not because you're obligated, but because you are withholding an opportunity to let their money work harder using the power of real estate. Here are 5 reasons family and friends often make the best private money lenders. Number 1, they already trust you. Private money is a relationship game. Your family and friends know your character, your work ethic, and whether you do what you say you're going to do. The trust shortens the runway. Number 2, they want a win without becoming a landlord. A lot of people love the idea of real estate, but they don't want the tenants, the toilets, or the 2 a.m. maintenance calls. Lending lets them participate in the upside without the headaches. Number 3, you can offer a clear, predictable return. When you structure it right, private lending can feel simple. Here's the amount, here's the term, here's the interest, here's how you get paid. For many people, that clarity beats the roller coaster of stock market investing. Number 4, you're helping them put their money to work on purpose. This is where the disservice comes in. If someone you care about is letting their money sit idle, losing buying power, and stressing about retirement, and you have a real estate vehicle that can grow it responsibly, why wouldn't you at least start the conversation? You're not taking from them, you're giving them options. And number 5, it strengthens your business and your community. When your deals are funded by people who believe in you, you're not just building your portfolio, you're building a little wealth circle. They win, you win, and everyone gets stronger. So RAIN Nation, here's the badass bottom line. Private money doesn't have to come from strangers in a suit. Sometimes the best lenders are the people already cheering you on. Just be a pro about it, be clear, be ethical, put it in writing, and only offer what you can confidently deliver. Because when you do it right, you're not asking for money, you're offering an opportunity to grow it using the power of real estate. Now, on to today's episode of the Real Estate Investor Growth Network podcast. Today's guests are Anthony Faso and Cameron Christensen, founders of Infinite Wealth Consultants and hosts of the Infinite Wealth podcast. Anthony is a U.S. Army veteran and recovering CPA who's worked at the world's largest accounting firm and served as CFO of a restaurant chain. But after the 2008 recession, he realized real financial freedom wouldn't come from Wall Street products. So he shifted to teaching and coaching people on smarter money decisions. Cameron, the ugly one, a longtime small business owner, was equally frustrated with traditional advisor advice, which led him to infinite banking and real estate investing. Today, they help clients build financial independence with more certainty, control, and collateral, so they're not stuck on the stock market roller coaster. It's my pleasure to have them on the show, so welcome Anthony and Cameron.
Jen, what a great introduction. I love that. You got the recovering CPA and the ugly one.
Came out swinging.
Normally we've been referred to as Cameron's the guy with the good hair and I'm the guy with the glasses. So I like yours better.
Oh my goodness. We are going to have a blast. I can already tell. So we are talking about infinite banking today, which is really basically becoming your own bank. And I have heard this multiple times. And as I was saying before we hit record, it kind of goes in one ear and right out the other. If you don't kind of use it, you lose it type thing. So I want you to really dumb it down. I don't know who's going to start here, but explain what infinite banking is and what is it like in real terms here. Who wants it?
I would say, overall, it's not that complicated. And here's one way that I like to explain it. Jen, do you use a rewards credit card?
Yes.
Why don't you just use cash?
Because it's dirty.
It is dirty. Okay, it is dirty.
It smells funny.
Or why don't you just use your debit card?
It's going to earn me money.
Okay, so what I'm hearing is I'm going to buy this thing anyways.
Okay.
By adding one extra step, a credit card, I get some extra bonuses, cash back or miles or so forth. If you can understand that, you can understand infinite banking.
All right. And that is all. Thank you for listening.
Yeah. Thank you. What I would say is we view our infinite banking, and we're explaining it a little bit more differently, but we use this as our rewards credit card for our investments.
Okay.
Like I wish I haven't found yet where I can get a down payment using one of my rewards credit cards, but the money's got to come from somewhere. So in essence, instead of using a credit card, we're going to use these infinite banking policies. But now instead of getting more miles, we're going to get more money in the form of compound interest. And in essence, in theory, our capital has to reside somewhere, right? And ideally, we want it somewhere that's safe and liquid. So when that opportunity comes, we can jump on it, right? So we basically need to store it somewhere that's safe and liquid. Most people will use a bank. And then as soon as they find that opportunity, they go invest in the asset. If it's a true asset, it's going to produce some cash flow or profits upon sale. We got to put that somewhere. We end up put it back in the bank. And then we build up to buy another one. That's what we found is most investors use it in maybe in some sort of way. But the downside is, every time you withdraw money from your account to buy an asset, we're breaking the compound interest curve, right? Jen, at what point do you want your money to stop compounding? What would you say?
Well, can you back it up and explain what you mean by compounding?
Oh, great. Compounding means that you're continually to earn interest. And then so let's just say for simple terms, you have $1,000 in there.
Thank you.
Right. And then let's say you earn $10 in interest. So that next year you have $1,010. So now you're earning interest, not on the 1,000, but on the 1,010. And then each year it compounds like a hockey stick, and then it just really starts taking off.
Gotcha.
Right? Now, Jen, at what point do you want your money to stop compounding? What would you say?
Never.
Good answer. Imagine all the rental properties you've had. If you would have been able to continue to compound the interest on those down payments, you think you'd have more money?
Absolutely.
Right. And then you could do more deals.
Yes.
Right. And you may be able to leave your W-2 sooner. I mean, so that's really in essence, like in the big picture. But what we're doing is we're not changing what you're doing. We're just changing where you're storing capital.
Okay.
Okay. We got to store it somewhere that's safe and liquid. What we found through research and crunching a ton of numbers, the best place to store that for most people, not for everybody, is in a high cash value whole life insurance. And Jen, if you're like me, the first time I heard this concept, I heard whole life and just some warning bells came out in my head, right? But I will say the way we're doing this, very different than traditional whole life.
Okay.
Very traditional whole life is designed for death benefit.
Right.
No cash value till year 4. Ours is the exact opposite. Minimize death benefit, maximize cash value.
Okay.
Okay, and so by just storing where we store the capital, not only is it safe and liquid, but because it's life insurance, it has other features. It's going to earn a higher rate than you are at the bank. It's going to be tax-free, depending on where you're at, but every state has some level of asset protection. Most of them, it's 100% protected. So you have an account just as liquid and safe as a bank. I'd even argue safer, but it has a lot more benefits. And we could withdraw the money from the policy if we wanted to and break the compound interest curve, or we can leverage against it. Meaning we take a loan from the insurance company against our policy. Now, and the reason why this works is we take that loan, that money, and that's our down payment. And then that cash flow goes back and repays the loan. But what's going to happen here at the end of once that loan's repaid back, your cash value continued to grow the whole time. It never skipped a beat because we didn't withdraw it. We leverage against it. So now we have more money. We still have the asset. But also because when we use these policies to create taxable income like real estate, we're actually creating tax deductions because we can deduct the interest we pay the insurance company, but the interest that they pay us is tax-free. So there is some arbitrage there. Jen, I'll let your brain take a little breather. Okay. So,
I need to go dig out that THC to maybe help me grasp this better. But here's my question. So I was a school teacher for 16 years, and then I went briefly into health insurance / life insurance. So is this a life insurance policy from anywhere, or are you providing that life insurance policy? Like, are you holding the reins on this?
I'll jump in there and take this one. I don't know how many life insurance companies that are out there, Jen. There's a whole bunch, probably several hundred. The companies that you would even want to consider for kind of infinite banking and the policy design that we're looking for, there's probably a dozen that kind of fit that bill. So if you jump online, you Google infinite banking, whole life companies, you'll whittle it down to probably 12 companies that fit that bill.
Gotcha.
We've been doing this for a while, 17, 18 years. And I'll tell you that we send most of our business to probably 3 companies. And as you get down to those dozen that kind of fit the bill, you start to find some intangibles where these 2-3 companies kind of start to separate themselves. A couple of the intangibles where they separate themselves are flexibility. Like, hey, I want to put a whole bunch of money in one year and then I want to put a little bit in the next. And then the other feature that Anthony was talking about were the loan provisions, where we build up the cash value and we can borrow against it. And those loan provisions are similar across companies, but they're not the same. So to answer your question, it's a very specific group of companies. And what our job is to find out what the client situation is and make a recommendation on which company and which policy is going to be best suited for them.
So Cameron, it's not in-house.
No, we're essentially brokers, right? So we can work with a dozen or more companies. Yeah.
Gotcha. All right, I forgot what my next question was. Okay, so when I was selling life insurance, there are people who have cancer, and you can't get a life insurance policy until you are 5 years cancer free. Do you run into issues like that when trying to get clients their life insurance policy?
If someone is uninsurable, right? God forbid that they're uninsurable, we can always look to place it on a family member
Okay.
or a business partner. The way that we're approaching these policies is the death benefit is really secondary, even tertiary, right? It's not our main concern. Really, what we're looking for is somebody healthy where we can kind of park that capital, like Anthony was talking about. So, if we can't put it on ourselves, we can find somebody else.
Gotcha. Great answer.
Mhm.
All right.
Yeah.
So you now, I mean, part of the concept is be your own banker. So I'm going to lob this back to Anthony here, because Anthony, you were talking about, you kept mentioning bank accounts, but now it's really, what does this become your own banker mean? Meaning that you are no longer making those deposits into a bank. It's into your health insurance, your life insurance policy.
Great question, Jen.
Okay.
And first, I would have loved to have been in your class. You must have been like the coolest teacher in the school.
And the
Okay.
best looking, by the way.
Yeah, and the
So,
best
fine.
looking, of
Clearly,
course.
obviously.
Yeah. But I would say you're still going to need a bank account, right? Because we need to move
Okay.
money around, right? This is more views like maybe like
Leverage.
a high yield savings account
Okay.
that comes with the death benefit. And the reason, and this was created, or maybe of the infinite banking concept, was R. Nelson Nash, who wrote the book Becoming Your Own Banker.
Okay.
And what he was focused on is how often we need to use other people's money, and we're paying interest to banks.
Yep.
And so most of this book is about getting rid of the bank and just financing things yourself, like financing your cars or paying off debt, right? Or equipment for the business. And that's probably what about 75% of the people in the infinite banking space approach it. Financing liabilities totally works for that. We're focused on using this to finance assets. Well, our goal is to help people create their passive income more than their monthly expenses. So we're using this storage tank of capital, and we're using this to finance really our down payments or our flips, right? So instead of going out and potentially borrowing money from others, what if we had our own system where we could borrow from? And because the one mistake people make is, and Jen, I'm going to put you on the spot because you seem like a playful person, but how many times have you used money from a bank, and did you pay them interest?
Ugh, yes.
Yeah, right. Now, how have you used your own money for a similar purpose, and how much interest did you pay yourself? I know the answer, right? It's not, because it's my money, right? And part of this concept is that if we are willing to pay Bank of America to use their money, but to use your own money, you don't pay interest. In essence, what you're saying, the Bank of America's money is worth more than mine.
Gotcha.
So, and I know that this is a little head trash thing that we do need to get around. But once we do, we kind of realize, because even when we use cash has a cost, right? If you put 100 grand on a down payment on a rental property, that means you can't buy another property,
Right.
or you can't earn interest on it, or a whole things of loss of can't. So that's what we call the lost opportunity cost. And we even do Jen, we got plenty of calculators. I can nerd out like the best of them doing the math, and we can illustrate that opportunity cost and the reasons why, at a minimum, you should be paying yourself the same interest you would be paying somebody else. And when you do that, that actually forces you to make better decisions. Because sometimes you're getting in a deal where really those margins are really kind of too small. And I know I've done this myself, where I really want this house, but when I look at the numbers, the margin's a little too thin. But then when I go to incorporate my personal borrowing cost for the down payment, it doesn't make sense. So it's allowing us to make better financial decisions.
So you need to be disciplined to
Yeah.
force yourself to make sure you are paying interest on it.
Well, you're right. This takes a level of discipline. But also that's the reason why you need to be working with an IBC coach who's going to be there to say, "Hey, Jen, I know you just bought this beautiful property, but you're not paying the interest on this loan." I mean, that's where you need somebody to coach you through, because there is a level of discipline, and that's why we're up front that this concept is not for everybody, but the people that it can be very successful.
So that is one of my next questions. You're saying who it's a good fit for, but who should not use infinite banking?
I'll jump in there. I got something to add to the discipline idea, Jen, if you don't mind.
Sure.
That is one of the pushbacks that I've got over the years is somebody will listen to this idea and they'll go, man, this sounds like you need a whole lot of discipline. I would argue that everybody has enough discipline in their financial life already to make infinite banking successful. And the thing that I'll always point out is I'll ask them if they've ever been late on a car payment to the bank. Have they ever been late on a mortgage payment to the bank? No, most people haven't, right? And so if you have enough discipline to pay them, you've already got enough discipline to pay yourself back. So that usually squashes that right there.
Good job, Cameron. It's not just looks with you.
Yeah, thank you. Then the second one you're asking was, who's this not for?
Yes.
Anthony and I will have different answers on this. So I'll go. What I would tell you is this is not for someone that does not want to take control of their personal finances.
Okay.
And I kind of had a double negative there. So if I'm going to say that kind of appropriately, what I would say is that if somebody wants to outsource their financial future to someone else and rely on someone else to make them successful or wealthy, this isn't for them, right? It's because Anthony and I are not the guy to come in and say, give me your money, come check back with us in 6 months and I'll tell you how it's doing. Is we're here to show you the tools and how to create wealth through passive income. We're not going to do it for you. So that's who I would say this is not for. There are no dollar amounts. There's no amount of premiums. There's no minimum requirements, right? It's really all about somebody that's teachable, somebody's got some ethics, and somebody that wants to learn.
Okay. So I get a whole life policy, and I'm going to leverage that. I'm going to borrow against it. How does this apply towards real estate?
Well, because this is where we're going to store our capital in between opportunities. So we got to that down payment's got to come from somewhere. I'll tell you, we're big fans of getting 30-year fixed mortgages and using leverage on the house. As long as the numbers work, the more leverage, the better. But typically you're going to have to come with some sort of down payment. And so we got to store that down payment somewhere. So we store it inside the policy. And then when you're ready to buy that property, we just transfer the money into your account and you put it you put it on the down payment. And then as that cash flow comes, typically what we typically do is we have people that are just paying the minimum amount or the interest only back to their policy. And that way we can get the tax deduction. And if you don't pay the interest, the beauty of it, that's okay. All they're going to do is just add it on the loan. So nothing negative outside of some additional interest is going to happen, but it gives you that flexibility. And I know we're using the L word of the loans. This, Jen, will be the easiest loan you've ever gotten. When you call up the insurance company, they're not going to run your credit. They're not going to ask you what it's for. They're not going to tell you how fast you need to pay it back. All they're going to do is ask how much and where do we send it?
Okay, so I'm buying a property and I need to come up with 25% to put down. So the first thing you said was I put it into my whole life policy first, and then the whole life policy pays it.
Yep.
And even though that money is now in that project, I'm still earning compound interest because it went through my life insurance policy.
Exactly.
And then now I have the property. So I'm going to just use real world example. I bought a beach condo recently and it was 400,000. I had 300, it's a BRRRR. So I have 300,000 from the hard money lender. I needed to come up with the remaining $100,000 for the purchase. I used a private money lender, but in this situation, could I have taken the private money's lender money and put it into the account, or has to come through me? Like I have to have $100,000 to put into my life insurance policy. That's where my question is.
We would, this is an advanced strategy, taking a loan or loan money and running it through a policy. That would only be for certain people. I mean, it can work, but we're very hesitant on, we want to make sure we can repay that policy loan back. So for a beginner, I would not recommend that. Okay. All right. But
for me, I would have to have that $100,000 to put into my account to them. Mm-hmm. Okay.
Jen, let's just change it. Let's just change your scenario a little bit. And let's say you had 100,000 in cash, right? That was yours that you were going to put into the project. What almost every real estate investor is going to do is they're going to keep that cash in a checking savings account, send it to the lender, right? Or for whoever the mortgage provider is for the down payment. The step that we're talking about is taking that cash, put it in the policy, and then borrow against it.
Gotcha.
That would be the one thing. Yeah, that's the one thing we're talking about.
Thank you, Cameron.
Thank you.
You made it. Sorry, I was going to go back. You just, if I may, is you made a comment. You said, "What does whole life have to do with real estate?" And I was going to try to give you an analogy. That's like asking, "What does a 401k have to do with the stock market?"
Okay.
Right. It's literally just the account that allows you to move into that vehicle or that investment.
Okay.
Right. So whole life is the account that allows you to move into real estate. Real estate is really our end goal. And I would also clarify that it doesn't have to be real estate. Based upon somebody's skill set, is we could invest in real estate or we could invest in a business, right? We can invest in anything that we know or anything that we see an opportunity in. So I hope that helps a little bit.
Okay. So this condo, I'm going to go back to it. So I have $100,000 that I inherited. And if I put it into this condo, I mean, I can do the BRRRR strategy and then I will pay myself back. But you're saying run it through the whole life policy so that it attaches to that, so that when I'm doing it, that's earning interest. What does the interest look like in the whole life policy?
I would say it's going to vary somewhere between 3 and 5%. So we kind of like to go somewhere in the middle at 4.
Okay.
Now that will be tax free. So that might be closer to 6 for some people.
Okay, that's important. So when I am finished with my BRRRR and then I go to refinance it into a DSCR loan, I am then putting my money back into this to the whole life policy?
Yeah.
Okay.
And then it is there ready for the next BRRRR.
Got it. But while I was hanging out at the beach, it was actually earning interest in there, even though it was lent out to this project.
Exactly.
Okay. See, Anthony, I'm impressed. And Cameron, you too. You did a good job. Because like I said, this is just it's just a hard concept to grasp because I have that background of selling life insurance where I'm like, so thank you for dumbing that down. So let's get a little dirty here. So what are three common pieces of financial what are the three most, I think this came from you all. What are the three most common pieces of financial advice that are flat out wrong for investors? Did that come from you all, or did my people write the wrong question here?
That's good enough. Yeah.
Yeah.
That worked. I don't know where it came from. Is Faso made it up? I don't know.
But are there three most common pieces of financial advice that are flat out wrong?
There's a bunch.
Okay.
Yeah.
Yeah. I'll grab one.
Okay.
First one that comes to my mind, Jen, is that I was on a call with the lady the other day. We jumped on the call and I asked her what her goals, what she's trying to get accomplished. and she said she was trying to multiply her net worth. And I would tell you that grading success on net worth for me is probably the biggest fallacy that's out there in personal finance right now. When I sit down and I talk to somebody and I really ask them what they're trying to accomplish, and I'll say, "What's your goal?" Right? You keep digging and they'll give you all the like high level stuff, and then you got to keep digging. And what it usually comes down to is I want to hang out, I want to spend time with the people I love, and I want to do the stuff that I enjoy doing. Right? So that's all about time. So to be able to have time to do that is we've got to have income coming in, right?
Okay.
And so for us to have freedom in our lives is we've got to play the game of creating passive income. And so everybody, most people out there are basing their financial success on their net worth. But in reality, we've got to define kind of success differently, and we've got to define it based upon passive income, like Anthony's shirt there. Nobody really has a strategy for creating passive income, right? They have an idea, but they don't have kind of a step-by-step process in creating that. And so that's one of the things that we help people do. The account that we've been talking about on the whole life side of it is just a place to store money, but that allows us to move into opportunities to start creating passive income. And that's what people really want at the end of the day.
I really thought Anthony's shirt meant that he loved 3.14. Because it
What it
says
is, I like
pie.
like coconut pie, Boston cream pie.
You call him Fatso.
Yeah. Yeah.
Faso.
Well, Jen, I would say another financial myth
Yes.
is that 401ks are your only path to retirement.
Yes. Say
Now,
it louder.
your listeners probably already know that, right? If they're
Yes.
listening to it. But man, how many times have you come across somebody where they're just in love with their 401k and that they think that the stock market and that's the only way to do it? But if anything, that's only going to push you farther away from financial freedom. Because we define financial freedom as when your passive income
Yeah.
is more than your monthly expenses. And so we use that as a compass. So when we're in a fork in the road and we don't know which path to take, we look at our compass. Is this increasing my passive income? Or is it decreasing, or is it increasing my passive income, or is it decreasing my monthly expenses? If it's one of those, then that's the path to take. But what happens is we tie all this money into 401k. The only advantage from a 401k is a tax deferment. And it's deferring, it's not going to be tax free.
Right.
And the myth that you're going to be in the lower tax bracket when you retire is false, unless you're failing, right? Because what that means is you're making less and less money. But I've seen too often, all people's money is in their 401k, which is taxable. Social Security is taxable. If they're working a little job or a side business, that's taxable. And their biggest tax deductions typically is the mortgage and the kids. Both of those are gone when we're in retirement. So we can very well end up being in a much higher tax bracket when we retire. Jen, sorry, I'm in recovery with the CPA. Like taxes just keep pulling me back in. But
Show her your tattoo, Faso. You've got a nice tattoo.
You have tattoos?
it's not that kind of podcast, is it? Or maybe that's the after podcast party.
So, okay, let's talk about the passive portion of it, because you keep saying this becomes truly passive. So I am hearing I'm buying a condo, putting my $100,000 in there first and using it towards the condo. Then when I go to refinance it into a DSCR loan, it goes back into my account, which is now grown by approximately 4% interest. And now I have more money to invest in the next project. That does not sound passive to me. What you're saying is passive is coming from the condo that's producing money?
Well, what I would say, we're trying to create passive income, and sometimes real estate is passive and sometimes it's active, right?
Okay.
And so this works whatever your asset of choice is. But if your asset class is active or if it's passive, that is what it is. But here, either way, that is going to take some capital. So this isn't. So storing your money is just really part of the business on whether your business is passive or active.
Gotcha.
I'll jump in there, Jen. I'll jump in there. Right, is first thing we got to do is we got to get organized. Once we get somebody in position where we've got their capital, where we can deploy it in the policy, they're gonna come. They're gonna come to a decision point. They're gonna say, "Hey, do I have more time than I do money? And if so, then I probably got to go an active route." Or they're gonna say, "Do I have more money than I do time? Then I've got to go more of a passive route." And that passive route is where we have capital and when we lend it, right? Like the private money lender is to you in this investment. That would be an example of private lending. So active has got a whole bunch of different opportunities that fall under that. And then same thing as passive. Which route they go is going to be dependent upon somebody's situation. And so that is also one of the things that will help somebody figure out is what's the best route for you.
And then in the end, you have now this like legit life insurance policy that is going to be left to your heirs on top, and that's grown exponentially, right?
Yeah, well, there's a couple ways when there's going to be a period when we're starting to wind things down, right? And so at that point, we're typically looking for more safety and security. So oftentimes people may liquidate volatile assets and put that in their policy, but there may be a time then we have some decisions to make. We could just leave the policy and then have that death benefit go income tax free to our estate, or what a lot of people will do is they turn their policy into cash flow that we've built up buying all these properties. We're building it up, never breaking the compound interest curve. We got this pile of tax-free money. We could give it to the charity or our kids, or we could draw it income tax-free, and that's part of a supplement to our retirement.
Wow. Okay. I need a breather after that. That was amazing, all of that you just said. So there are people, I will use my mother as an example, rest her soul, but she would always, oh, I don't want to invest. It's too risky. So how does this help with the whole risk tolerance for folks that want to get into this?
I would say, go ahead, Cam.
I was going to say, great point. Thank you. The point that I would make, I don't know if this is exactly what you're asking here, Jen, but I would position the whole life product not as an investment, right? The whole life product is just where we keep capital.
Okay.
This is literally the safest place that we can put money on deposit is with the insurance company. And the idea that it's going to grow 4% roughly kind of over the next 20, 30, 40 years, they've got a track record of doing that for almost 200 years. So that is about as close to a guarantee as we can get. So if somebody's looking for a place to put capital on deposit that's somewhere safe and easy, there's no better place. But what I would add to that is that is probably the least that we could do.
Okay.
Right? Is because if we just put it there and put it on deposit and leave it, we're missing out on all the opportunities to leverage and create that cash flow.
Gotcha.
So for your mom, right? From I forget exactly, I think it's maybe the silent generation. She may have been, I don't know exactly where she was.
Boomer. She's definitely a boomer.
Okay, all right. Well, the silent generation was big fans of life insurance and they used to use it. It used to be like the number one tool. And then the baby boomers got introduced to like 401ks and IRAs and stuff. And so that's probably where that idea of some volatility comes in at. But I'm getting off track there. But the idea of safety and security is synonymous with just cash value life insurance. So your mom should be in a good spot there.
So why should people never pay cash for their properties? Like she also was from that where it was a race to get your house paid off. So why is that not good advice?
Well, I would say, Jen, there's two things. One is, should I pay off my house or not? And two, if I'm buying real estate, should I use cash or should I use cash or not? And the downside of using cash is every time we withdraw that money, we're breaking the compound interest curve permanently.
Gotcha.
Right. And I will say, Jen, we oftentimes you hear us say that we've done the math. and we've really nailed it down on this example of because I guarantee you there's people listening, and Jen, that's I'm going to include you in there as well. Might be thinking, hey, I've heard the whole life's terrible. I don't need the death benefit. I just want to invest in real estate. I don't want to do all this loans and blah, blah. Totally get it. I just want to use cash. And what we've done, and we will do the math with every client based on like an illustration based on their personal situation, right? And the assets that they're buying. And what we will do is we'll do the math. All right, if I store the money in a high yield savings account, I'm going to earn some interest. I'm going to pay some tax. And what if I use that to buy a house? Or what if I put those same dollars in one of these policies that we're talking about, and we buy the exact same asset? Same money going in, same money going out. And what we do is we go through and we will explain who has more money, but more importantly, why. And really, the deciding factor is we're never breaking the compound interest curve.
Got it.
Right? Money's continuing to grow.
All right. So, I mean, this is supposed to help create this financial freedom for people. And how would you define that financial freedom?
Financial freedom for me is what's right there on Anthony's shirt: passive income greater than monthly expenses.
It's
Right?
not this.
Identify.
Well, I would say you don't have to be a badass to get financial freedom, but it sure as heck helps.
So people that are listening that are like, Jen is just going through here and not explaining this very well and asking the wrong questions. If they want to get involved in this, what are like the first 2 or 3 steps that they need to do to get involved with infinite banking?
We've got a couple. First one I would tell you, Jen, is that maybe somebody is very eager to kind of jump on a call with us. I'll have Faso give maybe the link there.
Okay.
But the second time, most of the time what happens with a kind of a podcast interview is somebody does have an interest. And what we've noticed is that people have heard about infinite banking over the years, but they don't quite understand it. And so the next easiest thing for them to do is to go do some research on their own.
Okay.
And so we have our own online course, and we will give your listeners free access to that course.
Cameron, thank you.
So they can go
Jen,
in there.
I was going to do that too. Okay. I was going to get free access to the course.
So they can go in there, look around, and they can watch all the videos. And right, like Anthony said, we do the math. When you go into the course, there's nothing salesy about it. It's all just videos of us kind of going through and doing the math. And so they can go to infinitewealthconsultants.com/REIGN, REIGN, and that'll take them to a landing page, and that'll get them into the course for free. So they can go in there, look around, get educated.
Awesome.
And also in there too is if you get to a point where you're like, you know what, I'm ready to talk to them, there's a button you can click in there that'll put you on our calendar.
Wonderful. So last question for y'all. Is this a scalable way to grow your portfolio?
This is probably the quickest way to scale your portfolio.
Well, because
if I'm being honest.
this is what I'm hearing. I'm hearing I have to put my $100,000 in, just like it's all going through my life policy to the condo that I just purchased, and I have to wait till I do the refinancing for it to come back out. So I can't do anything until I have refinanced it and put it back into my life policy. Is that correct?
Similar. If you didn't have a life policy, it'd be the same thing.
Correct.
Right. But what the difference is here is we're building more cash, we're building compounding. And at the beginning, just like the compound interest curves like a hockey stick, right?
Gotcha.
The angle's slow, and then it starts shooting up. Same thing here when we're scaling our business. It's going to start a little slow, but each time we do another deal, we're going up like a hockey stick.
Because I just remember when I first started in this industry, I was leveraging other people's money. I was using private money funds. So I'd be on one project and then start another project with somebody else's funds. So this is, as far as just the whole concept of infinite banking, it does the whole hockey stick towards the end there. So even if you are leveraging other people's money, this is a very smart way to start it now and get it going. So someone like me who is born in the early 70s, how would this work for me to get to the end of the hockey stick quicker?
Well, I would say a common misconception is people say, wait a minute, they hear life insurance, they're like, I'm too old. Okay. And first, that annoys me when they're younger than me. Okay. All right. I'm just putting that out there. Okay. I just got another policy last year. And, one thing we did, again, I like to say we do the math. We did a policy with the same premium on a 20-year-old, 40-year-old, 60-year-old.
Wow.
Okay. Jen, who do you think had more death benefit?
The 60-year-old.
Well, the 20-year-old had more death benefit
because they're going to live longer.
They're getting premiums for a longer period of time, right?
I did it backwards. Sorry. Yes.
Okay. So sorry to put you on the spot, Jen, but I'm going to do it one more time. Okay. Who do you think had more cash value on day one? What your instinct telling us is probably, well, the 20-year-old is going to have more cash because it's life insurance and they're younger. And this is a prime example of those theories you have about whole life insurance go out the window because we're designing it very different. Because in this scenario, the 60-year-old had more cash than the 40-year-old and 20-year-old.
Okay.
Now, not by much, probably in the rounding area, but that's an example of we're designing this for cash. Even when we went out 10 years, 40-year-old wasn't first, 60-year-old second, but again, not by much.
Okay.
So the thing is, wherever you got to start wherever you're at. Of course, this would be great if you started this in your 20s, but it's great if you start in your 30s, 40s, or 50s. We have people starting it in the 60s. And that hockey stick just might be a little shorter, but we're eventually going to start going up. But the thing is, you need to be in control of your finances.
Absolutely.
And infinite banking is not for everybody. I will say that for a real estate investor, for probably 90% of them, they should be incorporating this. And that I feel you owe it to your family to at least look into this, right? We're giving you free access where we're not going to call you. We're not going to hunt you down. Look at it. If it's not for you, at least you know, all right, I evaluated infinite banking and it's not for me. Perfect. But if you go through that, typically you're going to, that sounds interesting. It almost sounds too good to be true.
Right.
You want to learn more, and that's where you hop on a call with us, and we're going to explain the good, and we're also going to explain the not so good.
Okay.
And then we're design a policy or policies based on your goals and your finances. And then we're also going to coach you along the way to make sure you're paying the interest and you're making good financial decisions.
Okay, you guys are so great at this, and I thank you for dumbing it down for me. I have two final questions before we go to the second part of the podcast here, but what about deposits? Because I know, like with IRAs, you can only do a certain amount per year. Is there limitations on deposits into a whole life policy?
There's not.
Sweet. Okay.
So I'll give you
this is not a government-created plan.
Yeah. I'll give you a little more detail real quick. I know we're at the end, but you can put in as much as you want, right? Anthony and I have multiple policies ourselves, right? Is because we want to put in larger chunks or whatever. But you can have more than one policy. So if you go and you open up a policy that fits you now today, and then your income increases next year, well, great. You can continue to deposit in that first one, but you can also start a second one. And so that's usually the trajectory for most clients is we'll kind of end up with a portfolio of policies.
Nice. All right.
Yeah.
So last question, and it's over your right shoulder, Anthony, is that Rich Dad, Poor Dad book. How does that tie into this concept?
Well, I'll tell you, For me, I had my own CPA firm. I was following traditional financial advice, locking up money in my 401k, and then '08 happened. And my 401k turned into a 201k overnight. But some of my clients were actually killing it. They were the badasses during that time. And I'm like, what are you doing? What books are you reading? And then they told me a few books. One was Rich Dad Poor Dad, but I had already read it, Jen. But this time I'm like, instead of reading it, I'm going to put it into action. Right. And then when I found this book, Becoming Your Own Banker, I was able to combine the two where I use my capital to get my capital in order using infinite banking. But to get to financial freedom, I need to start buying cash flowing assets. So we incorporate them together.
Awesome. Very well said. And thank you for explaining it that way. That absolutely makes a lot more sense. am part of my neighborhood book club, and they have all these, fiction books that they do. And so I put up Rich Dad Poor Dad, and they're like, Rich Dad Poor Dad. I'm like, it's a parenting book. Come on, ladies, we'll read it. So they they have no idea what they're going to have to read here. So
Nice.
I
Well
am
done.
sharing it with all the little moms in the neighborhood. So, all right, I want to move to the second part of the podcast here, which is what makes Anthony and Cameron badasses. And we can just flip flop these questions. We don't have to do. So I'm going to go to Cameron with this first one. But what makes you all a badass? And I use the acronym BADASS, and the first letter is B for book. So you can't use Rich Dad Poor Dad. But Cameron, what is a book that's made a huge difference in your life?
The easy one is Nelson Nash's Becoming Your Own Banker. That
Okay.
would give someone a great foundation on that. But I'm going to give them a different one, Jen. I think at the beginning you said that some of your listeners have one foot in, maybe real estate investing, one out, right? They're trying to get out of it. The book that I would recommend that they read would be Tax-Free Wealth by Tom Wheelwright.
All
Tom
right.
Wheelwright is actually Robert Kiyosaki's CPA, and in that book, he does something that I appreciate and love. What he tells people to do is start with the goal in mind. And that's almost the exact opposite of the advice that almost every other traditional financial advisor out there is doing, is they start with taxes in mind.
Yes.
Well, right? So we got to start with the goal in mind. Where are we trying to go? And he walks through the accounts that are available for someone. And I'm going to ruin the book for some people, but if you guys are out there trying to chase passive income, none of the traditional accounts are going to work for you, right? And so you got to check out an alternate path, which we have found to become infinite banking. So if you guys are on the path, you're trying to change and say, hey, I've been doing the W-2, but I want to go out there and start creating income on my own, Tax-Free Wealth and Nelson Nash Becoming Your Own Banker, two great books.
Awesome, Cameron. Thank you so much. All right. The first A in badass is for advice. So I'm going to throw this to Anthony. You have given us great advice on this podcast, but what is the best piece of advice you've ever received?
Out. This might not be financial, but this is just one that really hits home, and this is my gut reaction. And this has helped me through some difficult times. Is if it doesn't kill you, it only makes you stronger.
Yes.
Right. And I've used that when I'm in a difficult situation, or I'm like, hey, you know what, this isn't going to kill me, or I hope not, but going through it, I'm going to be more experienced investor, or a better parent, or a better husband, or I'm going to be better from it.
Awesome. Very well said. All right. The next one is D for drive. What drives you to be successful? Either one of you want to grab that one? What
I
drives you
will.
to be successful?
I will. I hate losing. Right? I don't care what it is. I've always been this way. I do not want to lose, right?
Like
And
foosball?
foosball, no, I will fight to the end. I will spin those little
Spin
things
it
if
to
I
win
have
it.
to. I will jab that little thing into your stomach if you're standing too close to win.
What are we talking about here? Oh my
what
goodness.
what drives me to be successful is I want to provide my wife and my kids with a life that I didn't have, right? I mean, that's
Yes.
I think what everybody wants. And the realization I had many years ago was that, man, if somebody else can do it, why can't I? Right. And so that's what drives me to be successful is so and so figured it out. I certainly can too.
Absolutely. All right. The second A in badass, I'm going to give this to Anthony. It's for aspiration. I'm a big goal setter. So what is a goal you are currently working on? It can be finance, can be real estate, it can be personal. Doesn't matter.
I would tell you one thing I tell you, the lockdown and COVID really screwed a lot of things in my daily routine.
Mm-hmm.
And I used to wake up at 5:30, then with COVID, I ended up sleeping till like 8, right? But so what I'm trying to do is start my day right and getting some quiet time, getting some sunlight, some grounding, reading the word, and try and to focus in because I get so busy that I just jump into the work and I need to make sure I'm setting my day right and
Love it.
starting it right.
When you say grounding, does that mean put your feet in the grass?
It
Like,
does.
yes, I love
Yeah.
that. All right. The first S in badass is for systems. So this can go to either of you. What systems do you have in place to help you achieve success?
I'll take that.
Okay.
Is we have our PIOS. PIOS is an acronym for us. It's a passive income operating system.
Okay.
So, Jim, what we've been talking about today is an account, right? An account, the whole life policy is not going to get someone to financial freedom of where they want to get to, right? That's not going to be the wealth creator. Is it the best account to keep our capital? Absolutely. What's going to get someone to where they want to go in life is systems. And systems means you set something up and it should be happening automatically and repeatedly over time. And so our PIOS, our passive income operating system, is designed to help someone take their active income and turn it into passive income with very little management or oversight. So that I would say is what is proprietary to us and what we can share with others.
Very cool.
I would
Go
say,
ahead.
Cam, I'm impressed. I thought his system was going to be his hair care system of keeping that silky smooth, but I'm glad
I'm not sharing that. What are you
staying
talking about?
focused.
Yeah. Yeah. Nobody gets that.
All right. The final S in badass is for success. And this goes to both of you. What does success mean to you? I'm going to start with Cameron.
Two things. One, financially, is I need to be in a position not only to be self-sufficient, right? Because I'm not going to rely on anybody else, but I've also got to be able to lift others up with me, right? So whether
Mm.
that's my extended family or give back via charities or service, that's important to me. The other thing I would say is that personally is, man, if you come home and your personal life is not in order, right? Your house, your kids hate you, your wife hates you, doesn't matter how much money you got, none of that stuff matters. And so for me, success is coming home and having my kids be excited that I walked in the door, and same thing with my wife.
Well, I was excited to see both of you on this podcast today, and I want to wrap this up with Anthony. And before I do that, I want to thank you for your service. So thank you very much you were in the Army. Is that what I
Yes,
read?
Army, yeah.
Yes, thank you. So Anthony, if you will bring this home for us, what does success mean to you?
That has been like a changing target, right?
Yes.
When I was younger, it was to make $100,000. Even in high school, I wanted to claim $100,000 because I knew I was going to be living in Vegas. I might have some money outside the tax system, and then it got more personal to me of my goals. But I would tell you where I'm at now. I have 2 kids, and my goals is helping them become financially free. And so my son started a vending machine business, and he's almost there, financially free at 32.
Wow.
And my daughter's 26, just bought her first rental property. And so now my success is we're going to be more focused on my kids and my grandkids. My grandsons will be buying his first rental property April 1st.
Oh my goodness. Wow.
And Jen, you want to know how we finance his down payment?
I'm going to guess infinite banking.
Yeah, we started a policy on him when he was born, and I've been putting some money in there, and then now we're going to use that to buy a rental property. And so he's going to have rental properties and he's going to have passive income. So he ideally can do whatever he wants, not based on the money. He can start following the passions. And meanwhile, he's going to be learning about money the whole time.
I love it. So it has been an absolute pleasure having you having you two on today. So thank you very much. And one more time, how do they find you to set up that phone call to learn more? Cameron.
They can go to infinitewealthconsultants.com/REIGN, REIGN, and they'll have the landing access to the course, and there'll be a button there where they can schedule a call with us if they like.
I can't wait to check out this course. You all are amazing. Thank you for being with us today.
Thanks, Jen.
Absolutely. And that is all. Thank you for listening. And I will catch you on the next episode. Now go out there and share your badassery. And don't forget, make it a great day. Take care. Bye-bye. Whoop, whoop.
Thank you for listening to REIGN, the Real Estate Investor Growth Network. Be sure to subscribe on your favorite podcasting platform so you never miss an episode. If you need more badassery, you can follow Jen Josey by visiting therealjenjosey.com or become a member of REIGN by registering on reignmastermind.com.